I'll be golfing with some guys who will say, well, we're going to buy in the community, but we're going to wait. These prices are pretty high. Now they can't buy. They're
Right.
600,000 more than they were, 2 years ago, a year and a half ago. It's gone crazy. One of the houses just went on the market. It'll go for probably 200 more than asking. It was on for like 4 days. And it is, it's kind of crazy.
Hello, everyone. We have a very special guest today.
Hello.
We are honored and privileged to have Chris Scanlan here. And Chris is joining us from sunny Naples, Florida, where we met last. A little bit different than our dismal Atlanta day today. But Chris, introduce yourself. Tell everyone what it is that you do and a little snippet as to what we're going to talk about.
Well, I thank you very much for letting me address your audience here. But I'm the current president owner of the LIHTC Group, or a commercial real estate firm that have offices in Chicago, California, and Florida. We kind of handle market rate and affordable housing, which is apartment complexes throughout the country. My background was, I started very young and ended up buying a bunch of property by the time I was 28 and get my license and started a company and have built it from there. So we've seen a number of the ups and downs throughout the market. So we went through 2000, the .com, went through 2008, and the most recent COVID. So we have a little bit of a background on it.
I think you've seen so many tornadoes fly in and out of real estate, and I think you have a unique perspective in that you've seen it from the retail residential side. You've now seen it from the commercial side. So you have a vast knowledge as to how to look at the overall real estate market from a 30,000 view, not just in this microcosm that is residential, not only from a commercial side. So it's going to be a treat to really dive in and talk about some of our pressing, burning questions today. And Lauren's going to start us off.
Yes.
Wonderful.
So Chris, if you could whip out your crystal ball or perhaps some of your data, what are your indicators showing about the future of the real estate market for the next, let's say, 6 to 12 months?
Right now, we see a bunch of inflationary measures happening. You'll see here that in 2020, that gray section there actually denotes a recession area, and a recession is basically 2 consecutive quarters of negative GDP, yet negative growth. And what's ironic is this is the divergence of without getting too much into the weeds, the 2-year and the 10-year treasury surpassing and then going negative. What does that really mean, and what are you talking about? If you were to lend me money today and you said, Chris, how long do you need it out for? And I say, I just need it out for 2 years. And you say, oh, I'll just give it to you for a good rate. And if I needed money for 10 years, you'd say, for 10 years, you want me to hold it that long? I want a much higher yield for my waiting period. You'll see that in 2019, we dipped below. The 2-year was actually higher than the 10-year, meaning there's more risk in the short term than in the long term. So you'll see here in 2019 of September, we went negative, and they have 2-year, 3-year, 5-year bonds, but everyone looks at the 2-year and the 10-year, because there have been about 28 recessions since 1900. Since 1960, every single recession has been correctly predicted by this indicator. So if we look at this in 2019 of September, it went negative, and what happened? We had a recession, and it'll show a date here of somewhere around February or March of 2020, and it lasted until the pandemic was over. If you were to move that chart over, you'd see it again where it happened in 2008, 2007 is when it actually started. You could actually move that over and see that. If you were to go to 2000, it would show that everyone moving out of the stock market in the dot-com era moved their money into real estate, and real estate went up. So it doesn't always necessarily mean that we're going to have an awful period in real estate. It just means certain things will be affected. So that right now we are predicting a recession in 2023, not 2022. In fact, right now we see that prices will continue to go up dramatically. We believe somewhere between 11 and 15% from where we were in January, year over year.
Yep, through 2022. And so hinging on what you're saying, recession-wise, I think everyone probably just had their skin crawl, and they they may have melted down into their chairs. But let's break that down and let's really kind of like take the sting off that. So what
Sure.
does that mean, right? Like 2023, if this is all going to happen, what's that going to mean for our buyers and our sellers? And let's focus it on residential at the moment.
Okay, so we see, as you'll see right here, it dipped down again last week or the week before. It dipped down below and went negative.
Right.
We think that is a sign that over the next 24 months, we'll see sometime in there a period of recession. It may not be, it could be a very shallow recession. It may hit some form in the residential real estate. But typically, we see buyers who, if they don't get in the market now, will end up having much higher prices toward the end of the year. If the sellers, it will be a basket with them, because they'll have to figure out when is the best time to move. But most people move between May and August before school gets in and all that. So that would be a really good time for them to sell. We think that interest rates will continue to go up through 2022. And in 2023, we will see that the Fed increased rates so much that the economy will slow down into a normal rate, where we'll see probably the typical 3 to 5% increase in annual year-over-year housing prices. That does not mean we're going to see a dip. So in most cases and throughout most geographies, but as we all know, real estate is very local.
Yes, and that's one thing that Lauren and I both have focused on. You take the United States and you take the job market, and you have a big glaring spotlight on Atlanta specifically. We have been for so long an undervalued market, but now that we have so many industries that have put down roots, their headquarters, I mean, there's so much that's happened in the past, I'll say 6 years, in regard to where industry has moved to Atlanta, that we keep telling our clients to think that there's going to be some huge drop in prices. It doesn't make sense really for everything that we've seen inbound. And I can't tell you how many inbound clients I have had from Texas, New York, California, you name it. They see our real estate market here, and it's prime for the picking because it's so cheap compared to a New York. It's so cheap compared to almost anywhere in California. So we still, from our side and everything that we're seeing in our data, see that prices are going to continue to go up. And even in this recession that we're talking about, I just can't see a nosedive in pricing. Chris, what do you think?
I would agree with you. The only caveat to that would be back in 2008, we had about 23% of all mortgages out there were adjustable rate mortgages. Right. Today, that only accounts for about somewhere between, depending what your reading what models, but it's somewhere between 4 and 9%. You know, those people should either refi right now and get to a 30-year mortgage, because they're going to see those payments go up considerably when they reset.
Yes.
Yeah, those are, you know, on a $500,000 mortgage or a $450,000 mortgage, you're seeing $625 a month differences from where you were just 2 months ago.
It's huge.
Yeah.
Okay, Lauren, hit them with another good one.
So I'm curious, if you were talking about what our buyers and sellers should do with this information, is there anything that's more relevant to, say, our high-end luxury buyers versus maybe like the $500,000 to $700,000 price point? Would they be using this information differently?
Yeah, you have to use it differently because the markets are different. And especially, you know, here in Naples, Florida, we'll see the $2 million on up residential market doing unbelievably well. But it's those people who can't get into a home on the low end. And, you know, we're seeing some signs of it now where the third quarter of last year, the median home price was $411,000. By the end of the year, it was $408,000. We're waiting for the next quarter to come out here, but it should, we're expecting that to be a little lower again on the median, not the average. So, you know, above it and below it. But we're seeing a lot of on the luxury side. We, you know, I guess I think most of us might be in that luxury side right now where we're looking at. And here in Naples, I can't, if I sell my home here, I've got lots of equity in it. Where am I going to go? That's the biggest problem. And then capital is going to cost me more if I go up to the next level. So capital will cost me more. Still relatively low historically, but capital will cost me more. And then I better be ready to buy with cash, because if I don't, I have to sit on my house while I hope I can find something that might come available. And if I'm going to build new, which is a lot of what's going on in our market, they're tearing down houses and building something new. But now, when am I going to get into the house? It's and do I sell now because the seller's market is good, or do I wait until my house is ready? And now the market may have come down a little bit, although I don't think it will come crashing down. I think we'll just slow down. The biggest issue is when they were all calling for the transitory inflation. It can't possibly be transitory if we're hiring people at much higher prices. It would be transitory if it was just materials, and materials went back down to the mean. But if those go down, that would mean the only way we get back down to those prices is if the people who were hiring to build the homes, after the recession, they take a pay cut. That's not going to happen.
Yeah.
So these prices will continue to go higher. We're 4 million homes short of where we need to be. So.
Well, so hinging on the conundrum that you just talked about here. So it's that whole chicken and egg. I can do so well with my house. I can sell it. I know I can sell it. It's amazing. I have nowhere to go. So to really hone in on that, Lauren and I both have been incredibly successful. And when I say incredibly successful, 100% success rate in finding those houses for their next move. And we've been able to find it in a timeline that actually made sense for these clients. And that really speaks to our network. So we've been able to find these houses from calling, texting, emailing, you name it, we found them. So we've had 100% success rate in finding the next house for these clients because they knew they wanted to move, right? They were so hyper-focused on the fact that the house no longer met their needs because they were stuck in it for so long during the pandemic. And we've been really nimble in finding them and then still being able to capitalize on this great market for those sellers too. So we've got you covered. You want to move to Atlanta?
I'm actually going in Georgia, so I'm going to Georgia in June. So I'm gonna run through there. We'll see.
Okay.
And I would be calling you guys if I were to do anything.
Yeah, I love it. Well, I think that really is everything. You know, I think that this was a very good, comprehensive conversation on what maybe we can anticipate coming up just based off of data, what we've seen historically. And thank you for being such a font of knowledge in this space, because I think it's so informative and so wonderful to have a graphic to show people, because history tells the future.
It does.
Always.
It does. Thanks for having me on.
Yes, thank you, Chris, so much. Thank you, Lauren, and we will see everyone soon.